Okay, student. Our next topic is IAS 20, accounting for government grants and disclosure of government assistance. So it is what is the government grants in other countries like Europe, USA, or Canada. So they provide the facilities to their companies if they start any specific business, or if they provide a government associated any facilities. So they will provide a grants. They will provide them, give them some financial assistance, which help them to continue their business, such as they help in facilitating some anti-pollution machinery equipment, that they help them for job improvement or any recruitment, but they put impose some limitation. So this is a main thing for the government grants. This is the purpose of grants which they give to the companies. If they fulfill certain requirements, then they are entitled for the compensation. But in books of accounts, like under accounting standard, IAS standard, or IFRS, so how we will recognize IAS 20 is explaining the process. So how it is going to be considered or treated in your books of accounts. Governments often provide money or incentive to companies to export their goods or promote local employment. This is the one thing. So there are the government grants include revenue grants, like contributing towards the payroll cost, and the capital grants contributing to for the purpose of non-current assets, like help in the machinery equipment, or they give them facilitate in financial terms. Okay, general principles of IS 20, which follow the two general principles when determining the treatment of grants. The prudence. So, what is a prudence? Mean a grant should not be recognized until a condition of receipt have been compiled with, and there is a reasonable assurance that grant will be received. Prudence means that it is confirmed. This is a authentic thing which is going to, when they are going to get it, then according to that one it will be recognized in the books. Accrual. So grant should be matched with the expenditure towards which they were intended to contribute. Like if it is a grant is given by the government for 3 years time, mean you will accrual, make a transaction on the yearly basis. You will record the transaction in your books of accounts on yearly basis. So this is the meaning of this definition. According to the definition of para IS 20 para 3, so they explain about the government grants refers to government agencies and similar bodies, whether local, national, or international. So these are the bullets. You, if they ask you any word format, if any one or two markup point they ask about a definition, they will then you have to familiarize with this standard. So revenue grants. So the recognition of the grant will depend upon the circumstances. So revenue grants mean when they get a funds. If the grant is paid when evidence is produced that certain expenditure has been incurred, the grant should be matched with the expenditure. Bill to bill basis. So when if they produce a evidence and they all expenses, so they will get it paid. If the grant is paid on different basis, like achievement of non-financial objectives, such as creation of a specified number of new jobs, the grant should be matched with the identifiable cost of the achieving the objectives. Okay, make sense? You have to uh, clear by reading the requirement of the question in the exam. So you are very attentive on the before answering them. So you be careful. Presentation of revenue grants, how it is presented. Grants are either be presented as a credit in the statement of financial profit and loss, or the deducted from the related expenses. If it is a suppose it is for a related, it is given for the some specific use of asset or equipment. If its value is a 10,000, and then a grant is for the period is the 5,000 for 1 year. So mean to say, then assets net off, and then they consider 95,000 assets value in their books of account. This is the meaning of the deduction from the related expenses from the assets itself. So this is the easier one. So it will once a very easy topic. So you just so familiarize, and it will be very much on your fingertips. So we see this illustration. So entity is given 300,000 on 1st January 2000 X to keep stuff implied within a deprived area, specific area which they allocated. The entity must not make redundance, they not remove the staff or fire the staff for the next 3 years. If they recruit somebody relating to the job, so they will not fire him or her for the period. The grants will be otherwise the grant will need to be repaid, so they have to refund the grant. And this is a reason. So 31st December 2000 X, focus on the dates. No redundancy have taken place and none are planned. Okay. Grants should be released over 3 years, meaning that 100,000 yearly basis. Understood? This can be shown as a separate line in the statement of P&L or deducted from the administrative expenses of the staff cost charge. In the books, 100,000 have been released in the statement of profit and loss. The remaining 200,000 will be held in the under the deferred income to be recognized for the next 2 yearly basis. They will keep recognizing. Of this 100,000 will be released within the next year, so will be held within current liabilities, and remaining 100,000 will held as a non-current liabilities. So this treatment will be have to practice. It will be very much clear. Capital grants. IAS 22 permits two treatments. So write off grant against cost of non-current assets and depreciate the reduced cost. They treat the grant as a deferred credit and transfer of portion to revenue each year, so offsetting the higher depreciation charge on the original cost. So it is also method which is normal in practice under this treatment. The treatment of capital grants, how the capital grants are treated. Grants for the purchase of non-current assets should be recognized over the expected useful life of the assets, like same like the other normal assets. If you buy a machinery for and the useful life is a 10 year, it's divided by 10. IS 20 permits to treatment. Both the treatments are the equally acceptable and giving the fair representation. Method 1, on initial recognition, deduct the grant from the cost of the non-current assets and depreciate the reduced cost, as we discussed earlier. Method 2, recognize the grant initially and deferred income and transfer to the portion to revenue each year, so offsetting the higher depreciation charge been there. Method 1 is obviously far simple or to operate. Method 2, however, has an advantage of ensuring the assets. So we will, as a student, we will go for a easier one, which is very much easy to understand. How this is understanding in next illustration they have are their understanding they have asked for it. Entity: open a new factory and receive a government grant of 15,000 in respect of capital equipment costing 100,000. It depreciate all plant and machinery at 20% straight line basis. So careful from the information given and see what they require. Show the statement of P&L, profit and loss, and statement of financial position. Extracts mean the part of the show the same the specific part of the financial statement. So that is no need to mention other areas, just make an extract of that one of the grant for the first year under both method. Under both methods, statement of financial position under statement of financial position method, and this is the other method for the profit and loss method extraction. How you will make, like $100,000 is your value of the equipment, 15,000 is your grant. Straight away 85,000 is the balance amount is deducted from the total amount. The P&L will be there. They said the 20% will be straight line method. So if you make it apply the 20% on 85,000, the 17,000 will be expense. On the financial statement side, 85,000 same figure will be over here, and then 17,000 the depreciation amount will be there deducted, and after that 68,000 will be shown in the asset your statement of financial position. This is the way how you will treat in the books of accounts. Okay, next topic is the borrowing cost. I under IAS 13. So borrowing cost they will explain it. It is very easier and very much clear concept and a very interesting one also. So when it is come, you will definitely get the full mark from this area. The borrowing cost definition is the extent to which the entities are allowed to capitalize borrowing costs incurred on money borrowed to finance the acquisition of certain assets. Suppose if you are have a construction of some specific area or the plant or equipment which need a construction, and it need maybe 6 months time or 1 year time. So whatever time if you need a borrowing, if you borrow funds from the bank or financial institution, so whatever borrowing cost will happen, so it is if it fulfill their criteria, like borrowing cost must be capitalized as a part of the cost of an asset if that asset is a qualifying asset, one which necessarily takes a substantial period of time to get ready for the intended use or sale. So if it is a purely for business purpose transaction, then you fulfill this criteria, so it will be finance cost can be capitalized under this asset value, they can add it on, or if it is not fulfilling, so it will be expense out. So how the commencement of capitalization will happen take place? IS 23 state that the capitalization of borrowing cost should commence when all the following condition met. These three conditions: expenditure of the assets are being incurred, purely borrowing costs are being incurred, okay, activities that are necessary to prepare the asset for its intended use or sale or in progress when the equipment or business activity is ready to move on, so that stage it will be recognized. It's not like that it's on the way or under construction, so you cannot charge it over there. So we'll go for there is an illustration, so it will clear your concept. So how it is going to happen? If an entity had a 10 million on 6% loan and 2 million 8% loan, the weighted average cost of borrowing would be, what will be the weighted average cost of capital? So total is there is a 12 million. So 10 million is at a 6%. So 10 million by 6 plus 2 million at the 8% over divided by 12 million. It is a weighted average is coming as a 6.33. This is a simple one method is there which you need to apply for to calculate the weighted average, and there is a detailed part will be there for your understanding. We will do it like on January 1. Please just go through this understanding 3. So what is their requirement and how it is going to applicable and how we will make a solution. Just go through this thing and see their requirement first. Calculate the total amount to be included in cost in property, plant, equipment in respect of development on 31st December. Okay, and that this understanding, they said on January 1st, 2005, a company began to construct a supermarket which had an estimated useful life of 40 years. It purchased the site for 25 million. The construction of the building is a 9 million, and the fixture and the fitting are 6 million. The construction of the supermarket was completed on 30th September 2005 and it was brought into use on 1st January. Be careful and watch these dates and periods. There is a tricks are also there. So it is ACCA is not going to give you, there are the easy marks. So this is the exam tips, there are easy marks, but you have to careful about the duration, about the timings where they are playing with you. Okay, Sensco borrowed 40 million on 1st Jan 2005, 1st Jan. In order to finance this project, the loan carried interest 10%. It was repaid on 30th June 2006. What is required? Calculate a total amount of included in cost in property, plant, and equipment in respect of the development at 31st December 2005. Okay, so first of all, you will include whatever they are saying, whatever in under PPE, whatever how much total will be there. So you will include on like 25 million first of all for the property plant or the purchase site is your 25 million for the site, and then the construction of building is 9 million. So you will add it on 9 million, and then it is saying the fixture furniture fixture will be 6 million. We will add it on 6 million, and then finance cost or the borrowing cost, how much we will include. This is a part of, this is the main thing what you will. So they saying they borrow 40 million in 1st January 2005 in order to finance the project. The loan carried interest this. Okay, that's saying the construction of the supermarket was completed on 30th September. So it's mean it was completed on 30th September, and then loan was repaid on 30th June 2006. But we are preparing the financial extraction of this amount, how much will be accounted for. This is these figures we will add it on, and finance cost we will bring it. So it is there for 1st January to 30th September for 9 months period. So this is the main thing. So 9 months period only you will account for. So you will when you calculate 40 million of 10%, you will make it 40 million at like 10%. There 9 over 12. So this way you will calculate. So how much will be coming in your answer? It will be 3 million for the total. The total assets value will be 43 million, which need to be accounted for in your books of accounts. So this one will be easier one. So like easy bit they will give me test in your exam question in under financial reporting. So last topic of this chapter is IAS 40 investment property. So investment property you have to memorize as we discussed earlier. All IAS or IFRS things, whatever is there coming in your textbook, so you have to memorize according to your exam style. Okay, investment property is a land and or building held to earn rental or for the capital appreciation or both. This is the definition rather than for the use of entity or the sale of ordinary course of business. So this is the definition of investment properties. So if it is coming fulfilling this criteria, so then it is treated as an investment property. Like owner occupied property is excluded from the definition of an investment property. So these are the property not used by entity in general operations. Okay, there would be a spare properties rented out to third party or specifically bought in order to profit from a gain in value. This one will, if it's fulfilled, then it's okay. There could be a situation where a building can be accounted for in two different way. If entity occupies a premises but rent out certain floors to other companies, then the part occupied will be classed as property, plant and equipment as per IAS 16. with the floor and rented out classed as an investment property for the income purpose or the rented out purpose. This paragraph explains the whole concept, how you are going to treat it in your books of accounts. Consolidation. Under consolidated account, if an entity owns a building that is rented by a subsidiary of an entity, then the building will be classed as an investment property in the individual entity financial statement, but will be classed as a property, plant, equipment under IAS 16 in the consolidated financial statement. This is because the asset will be used by the group, so must be accounted for in accordance with the IAS 16. Okay, the how the accounting treatment will happen for IAS 16. Investment property should initially be measured at cost. Okay, if IAS 16 the 40 then gives a choice of subsequent measurement between the following: cost model or fair value model. At cost, whatever is their invested amount, so it consider, or fair value according to the market value. Once the model is chosen, it must be used for investment property. This is also a rule, so it is not a choice. So when property go up, you will use a fair value, or if it is go down, you use a cost model. So it will applicable. Cost model. Under the cost model, assets should be accounted for in line with the cost model that as per IAS 16. Fair value model is says the assets is evaluated at to a fair value at the end of each year. The gain or loss shown directly in the statement of financial position. No depreciation is charged on the asset. Fair value is normally established by reference to current prices. This rule will also be applicable as per the active markets for property in some location and condition. Here they say, if an asset is transferred from property, plant and equipment to investment property and fair value model for investment property is used, the asset must first be revalued as per IAS 16, creating a revaluation surplus in equity and then transfer into investment property at fair value. Okay, so correct. If the cost of model is used for investment property, then the asset is transferred into investment property at the carrying value and continues to be depreciated. If the asset is a transfer from investment property to property PPE equipment and the fair value model for investment property, so then the revaluation will be applicable as per this one, taking gain or losses to the statement of financial position. If the cost model is used for the investment property, the asset is transferred into property, plant and equipment at the current carrying amount and that continues to be depreciated. So these are the rules and their condition which need to be met accordingly, just to and again have an understanding on all concepts clearly. Okay, student, this is all for the chapter 2. So we have gone through. This is a easy bit, but it is helpful for your understanding and all your clarifications are there. If you have any question, you can message over here. And this is a chapter summary also available. How this is a complete chapter as we discussed. Like again, I recap, like tangible non-current assets and measured under IAS 16, which is the property, plant, equipment, and then investment properties are there. So like a cost model, hold that cost minus depreciation, fair value model is equal to revalued at each year end. So these are the models, and then this is again it is also like you make a map like this, and it's helpful for you, or you can print it out and it's helpful for you for your further revisions. Or if you are a paid student, then you can have a pass card also will give you all these details, and the revision kit also will be provided. We follow Kaplan study text and the revision kit and all other material. If you have need more detail or detailed learning, and where we assure you complete pass assurance and pass guarantee, you become a member of our team, and then you become a member student. Definitely you will receive all live classes and live practices, mock exam, and we help a student in all areas which need to clarify all topics, and absolutely everything will be very clear. So you will be get a personalized a tuition as a complete if you are working professional, or if you are a full-time student, definitely you will get full support from us until you pass it. So we help you out in all areas: revision, practice, mock exam. We make a market also for you. We give you according to ACCA marking scheme. So this is a big understanding is also required. So where are the marks? Sometimes students their marks are available for 4 marks, and student writes too much whatever. If sometime examiner gives you easy part with the 4 marks, but student keep writing, and just they don't think it need only 6 7 minutes to write it down, but they keep writing up to 20 minutes, and then they miss their other important parts. So don't do this practice. You have We will discuss all more techniques also, which will helpful for students to gain a good marks. Good luck. See you in chapter 3, and all the best, and keep learning and keep practicing.